Hey everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today we are diving into a topic that becomes incredibly important whenever markets start to shake and headlines turn negative. We are talking about one of the most practical questions any investor or trader can ask: which sectors actually perform best in a recession? More specifically, we are going deep into identifying the best sectors during recession periods, why they hold up, and how you can think about positioning yourself when the economy slows down. Now, recessions can feel unpredictable when you're in the middle of them. Markets become volatile, sentiment shifts quickly, and it can feel like everything is falling at once. But here's the truth: not all sectors react the same way. In fact, some industries remain surprisingly resilient, and a few even benefit from the changes in consumer behavior. So let's break this down in a clear, practical way. First, we need to understand what actually defines the best sectors during recession conditions. There are a few consistent traits you'll notice. The sectors that perform best usually provide essential goods or services. These are things people simply can't cut out of their lives, even when money is tight. Demand in these areas tends to remain stable, or at least far more stable than in other parts of the economy. They also tend to have predictable cash flow. That matters a lot when uncertainty is high. Investors start prioritizing reliability over growth. And finally, many of these sectors are known for paying dividends. That steady income becomes much more attractive when capital gains are harder to come by. On the flip side, sectors tied to luxury, travel, or big discretionary spending tend to struggle. When people feel uncertain about their income, they cut back fast, and those industries feel it almost immediately. So with that foundation in place, let's start looking at the sectors that consistently hold up. Let's begin with consumer staples, which are often considered the backbone of defensive investing. This sector includes companies producing everyday essentials. We are talking about food, beverages, cleaning products, toiletries, and basic household goods. Now think about this in real life. Even during a recession, people still need to eat. They still need to clean their homes. They still need basic hygiene products. What changes is how they spend, not whether they spend. People might switch from premium brands to cheaper alternatives. They might cut back on eating out and cook more at home. But the overall demand for these core products remains steady. That's what makes consumer staples one of the best sectors during recession periods. These companies benefit from what's called inelastic demand. In simple terms, demand doesn't drop much even when incomes fall. They also tend to generate stable revenue and, in many cases, pay reliable dividends. Large, established companies in this space often have strong supply chains and pricing power, which helps them stay resilient even when conditions are tough. Next up is healthcare, another consistently strong performer during economic downturns. Healthcare covers a wide range of areas. Hospitals, pharmaceutical companies, biotech firms, and medical device manufacturers all fall under this umbrella. What makes healthcare so resilient is simple. It's not optional. People don't delay urgent surgeries or stop taking essential medication just because the economy is slowing down. In many cases, demand remains steady or even increases. There are also broader trends supporting this sector. Aging populations, for example, continue to drive demand regardless of economic cycles. And in many countries, healthcare spending is supported by governments, which adds another layer of stability. So when investors look for the best sectors during recession, healthcare almost always makes the list because it combines necessity, consistency, and long-term demand. Now let's talk about utilities, which are often seen as one of the most reliable defensive plays. Utilities include companies that provide electricity, water, and natural gas. Again, these are basic needs. Whether the economy is booming or contracting, people still need power in their homes. Businesses still need electricity to operate. This creates very stable demand. On top of that, utility companies often operate in regulated environments. Governments typically control pricing to ensure stability, which reduces volatility compared to other sectors. Many utility companies also pay consistent dividends, which makes them attractive to income-focused investors during uncertain times. Now, utilities aren't known for high growth. You're not looking at explosive returns here. But during a recession, stability and predictability become far more valuable. That's why utilities are always part of the conversation around the best sectors during recession periods. Let's shift to something a bit more dynamic: discount retailers. This is where things get interesting. During a recession, consumers don't just stop spending. Instead, they change how they spend. They become more price conscious. They look for value. They trade down from premium brands to more affordable options. And that's exactly where discount retailers benefit. This includes dollar stores, budget supermarkets, and off-price clothing retailers. These businesses often see increased foot traffic during downturns. People who might not have shopped there before start looking for cheaper alternatives. That increase in volume can drive strong performance, even when the broader retail sector is struggling. So while traditional retail might suffer, discount retail often stands out as one of the more underrated recession-proof sectors for investing. Another sector worth discussing is communication services. In today's world, staying connected isn't optional. It's essential. This includes internet providers, mobile networks, and in some cases, streaming platforms. Even during economic downturns, people prioritize connectivity. They need it for work, communication, and everyday life. Many companies in this space operate on subscription models, which creates predictable, recurring revenue. Customer retention is also high. People are unlikely to cancel their internet or mobile service, even if they are cutting back elsewhere. So while some areas of entertainment might see reduced spending, core communication services tend to remain stable, making them an increasingly relevant part of the best sectors during recession conversation. Now let's touch on energy, which is a bit more complex. Energy doesn't always behave like a typical defensive sector. Demand can drop during recessions due to reduced industrial activity and lower travel. However, not all energy companies are affected equally. Large, integrated companies with diversified operations tend to be more resilient. Businesses involved in energy infrastructure or long-term contracts can also maintain more stable income. So while energy isn't always a top performer across the board, selective investments in strong, well-managed companies can still hold up reasonably well. The key here is being selective and focusing on fundamentals like balance sheet strength and consistent cash flow. We also need to talk about precious metals, especially gold. Gold isn't a sector in the traditional sense, but it plays a crucial role during economic uncertainty. When markets become volatile and confidence drops, investors often move toward assets that are seen as stores of value. Gold has historically served that purpose. It doesn't generate income, and it's not about growth. Instead, it's about preservation and diversification. Gold often moves independently of stock markets, which makes it a useful hedge during turbulent periods. So while it's not a replacement for equities, it can be an important part of a broader recession strategy. Now, just as important as knowing what works is understanding what typically doesn't. Certain sectors tend to struggle significantly during recessions. Luxury goods are a clear example. High-end retail depends heavily on discretionary spending, which drops quickly when consumers become cautious. Travel and tourism are also highly sensitive. Vacations, flights, and hotel stays are often among the first expenses people cut. Automotive sales, especially new vehicles, tend to decline as people delay big purchases. And real estate, particularly commercial property, can face pressure due to reduced business activity. These sectors rely on confidence and spending power, both of which tend to weaken during economic downturns. So how should you approach investing during a recession? First, diversification is key. Even within defensive sectors, you don't want to rely on a single area. Second, focus on companies with strong balance sheets. Businesses with low debt and stable cash flow are better positioned to handle economic stress. Third, look for consistency. Companies with a track record of steady earnings and dividends tend to be more reliable during uncertain times. And finally, having the right tools can make a real difference. If you're actively trading or managing investments, using a platform that allows you to track markets, analyze trends, and execute efficiently is essential. If you want something modern, intuitive, and built for today's markets, you can check out this world-class trading platform here at crystalballmarkets.com/platform. It's designed to help you stay on top of opportunities, even when markets are moving fast. And just as important as tools is education. Recessions can feel overwhelming, especially if you're newer to the markets, but they are also one of the best times to learn. Understanding macro trends, sector rotation, and investor behavior gives you a long-term edge. If you like learning in a more relaxed, practical format, I'd highly recommend checking out this podcast series at iss.com/podcast/crystalballmarkets. It covers trading, investing, and financial markets in a way that's easy to follow and actually useful. So to wrap this up, the best sectors during recession periods are usually the ones tied to essential needs. Consumer staples, healthcare, utilities, discount retail, and communication services all tend to hold up because demand doesn't disappear. At the same time, sectors tied to discretionary spending often struggle. Recessions are never easy, but they do follow patterns. And if you understand those patterns, you can make more informed decisions. That's it for today's episode of Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next one.